Hey guys, in today's video, I'm going to show you a simple but powerful trend following indicator that you can apply to your charts right now to improve your trading success. I'm also going to show you how you can take any indicator you find interesting on TradingView, put it into your own Pine script so you can test your own signals. Stay tuned to the end because I'm also going to show you how to take that same code, put it in a strategy tester on TradingView so you never have to manually backtest again. So let's get cracking. This one is jam-packed. So today I want to introduce a potentially powerful trading tool that is simple yet effective. And this tool allows you to capture large upside, whether the market is moving up or down, by capturing the lion's share of powerful trending movements. And this is a nice tool in the hands of any trend following trader. But what's nice about this particular tool is that it's really good for beginners particularly, because it's very easy to use. It captures large movements. It has enough potential complexity that you can enable or look at if you so desire, if you want to be more advanced with it and optimize your trading style. And it can be used completely on its own with a risk management and stop and target system as a full trading system. And it has components in it that individually could be singled out as very good initiators or confirmers. So I think this is a very good indicator for beginner traders to start with if they're struggling to find their initiator, their entry indicator. So the indicator is the VWMA SMA breakout detector. And I'm going to be demonstrating it using a TradingView script that was written by Profit Programmer on TradingView. He's written quite a few scripts, and it's been a while since he wrote this indicator, so it's in V3. So throughout this presentation, we're going to be looking at how we can use this in its original format, but I'm also going to show you how you can take this indicator and create a strategy tester, iterate upon the original initiator code, and then begin immediately backtesting this. And I'm going to talk about my findings so far. Let's talk about the indicator itself. And by the way, full credit to Profit Programmer for coming up with this idea and iterating upon this, but we're going to try and make our own as well. So the core concept of this indicator is very simple. It is a moving average indicator. So it uses 4 different moving averages. It uses 2 volume weighted moving averages, one fast and one slow, and 2 simple moving averages, one fast and one slow also. Now, the theory behind this indicator is that volume is not taken into account when calculating our simple moving averages. And simple moving averages are very much at the base of many, many indicators and many different trading strategies in one way or another. Therefore, if we actually compare what a volume weighted moving average is doing in relationship to a simple moving average, we can interpret the underlying strength of an emerging or existing trend. Based on this simple idea, a healthy trend is supported by increasing volume. This increase in volume indicates that the interest to buy whatever asset we're charting is increasing, that there is a sufficient influx of new buyers coming into the market that are interested in participating, and therefore we can expect the continuation of this upwards price movement. Same thing with downwards trends. If we see that volume is declining while prices are declining, we can interpret that there is a lack of sufficient buyers who want to come in and begin purchasing the asset. Therefore, if we don't see any increase in volume in a downtrend, we can be relatively certain that the market is not going to turn around anytime soon. Now, on the other hand, because we are comparing 2 different things, a volume weighted moving average and a non-volume weighted moving average, if we see volume declining while price is moving up, this is then a divergence of volume and price action. If volume is not increasing in step with price, this divergence generally indicates that the trend, i.e. the upwards price movement that we're charting, is weakening or has become weak, and that a pullback or a complete reversal of the trend is coming soon. If we use that concept alongside this indicator, we would want to see our volume weighted moving averages trending above our simple moving average to confirm that we have a volume supported uptrend. If during that uptrend, we see that the volume weighted moving average begins to fall below the simple moving average, we can identify that as bearish divergence, and we begin to look to either exit our position, begin scaling out of our position, or even potentially fade the top of this upwards price movement if we are relatively certain that we're coming to the end of the trend. Same thing, if we're trading to the short side or we're looking for market reversals in a bearish trend, we can simply flip this idea on its head. If we see price in a downwards trend and our volume weighted moving average all of a sudden begins moving above our simple moving average without an immediate reaction from price, we can identify that as bullish divergence. And we can either look to exit our short positions, begin scaling out of our short positions, or potentially even look to take a reversal long because the evidence shows that we might potentially be getting a reversal in trend. If we wanted to use this indicator right out of the box, we can just simply use it the way that it is. Trade entries can be made when either the fast volume weighted moving average crosses over the fast simple moving average. That would be a very aggressive trading style. Or when the fast volume weighted moving average crosses over the slow simple moving average. That would be the more conservative and more common approach. You can always, of course, use the simple moving average crosses themselves, but I would use those as confirmation or potentially areas to scale into your position rather than as the signals themselves, because then you're just using simple moving average crosses and you're better off just throwing a couple simple moving averages on your chart rather than this indicator. So the first thing I want to do is I want to do a quick eyeball test and see if this thing looks decent enough to trade. And I also want to begin showing everybody how they can take this indicator or take any indicator they're interested in and do a little bit of tiny work in TradingView to get a back test. So the first thing that we want to do is we can come down, the code is public, so we can just simply copy this code and bring it over to TradingView. And you guys will see that I've done quite a bit of work here. So what we're actually going to do is, boom. So we're just going to copy the code over. And as we can see, this code was written in version 3. So we want to get this up to date to the most current version of Pine scripting language, or excuse me, TradingView scripting language Pine, and get this over to V5. So we can do that with Pine's built-in converter. We just simply click these 3 dots in the top right, and we click convert to V4 and click save. And boom, we've got a version 4 indicator. That's not all though. We've got to get this thing to V5. So one more time, 3 dots, convert to V5. Boom. This is very handy. If you see an older indicator and you want to start playing around or iterating upon it with the new features that are available to us in V5, whether that be with the use of arrays or plotting or drawing trend lines automatically, we want to get that to V5. So again, using the built-in converter will save you a ton of time going through and changing all the little things. Okay, so our code looks like this now. Let's see how she looks by adding this to the chart, and not bad. Let's compare that against the original one. Not too bad. Just a little bit of a change in colors because V5 did deprecate the transparency function. I'm totally fine with that. If you want to, you can come in here in these fill commands and you can edit this with the color new command where you can actually specify how much you want it to be transparent. But for our purposes, I am not going to worry about that. All right, so we're going to add a little bit of code to our indicator now. And I'm just going to copy over from the code that I already did. This is the code that we are going to copy right here. And we can just plot this in. And this is very useful. This is kind of the same boilerplate code that I use all the time. And I'm going to explain what I'm doing here after I get this uncommented. Okay. So all I'm doing here is I am identifying what the potential signals that this strategy can produce. So remember, we're using 4 different moving averages, a fast and a slow volume weighted moving average, and a fast and a slow simple moving average. So Again, we can either take trades when the fast volume weighted moving average crosses over the fast simple moving average, or we can take trades when the fast volume weighted moving average crosses over the slow simple moving average, or we can take trades when the slow volume weighted moving average crosses over the slow simple moving average. So all I've done here is I've coded all 6 of those possibilities, 3 possibilities for upside trades or crossovers, and 3 possibilities for downside trades or cross unders, so we can look at both longs and shorts. So this code is very easy to do. In V5, it's just TA, just whatever you want it to be. In this case, I chose fast, medium, and slow up crosses, and fast, medium, and slow down crosses. And we've got TA crossover is the command, and then you just put in what you want them to be. And these were already predefined by the original script author, so they're defined right here: fast SMA, slow SMA, fast WFA, slow VWMA, excuse me. Okay, cool. So we have coded our conditions for what we might want to trade. And all I've done now is we're going to be doing eyeball tests. So all I've done now is I've coded up some simple plot shapes. And the exact way that you do this can be different based on your personal aesthetic preference and what you like to see. First, we'll start off with how this works. It's just the plot shape command is the function that you'll call. And we're going to put in as our first parameter or argument what we want to plot. So we want to plot something when a fast up cross occurs, and then a second one for a medium up cross, and another one for a slow up cross. Then we give whatever the signal is a name, doesn't matter what it is. And then we give it a style. And this is actually the shape that's going to print onto the chart, and where it's going to print below the bar, and then the color that we want to print. Now, you can obviously select whatever color that you like. A lot of individuals will use green for buys and red for sells. Personally, I don't like that. There's a lot of, I can tell you from my personal experience, and there's also a lot of science on this, that colors do elicit emotional responses in us based on what color they are. And so I like to avoid emotionally charged colors, particularly when I'm trading, particularly when I'm charting, because it can influence my decision making. So in the past, I would use green for buy signals and red for sell signals. And now I prefer to use white and gray. They're neutral, and they prevent me from making emotionally charged decisions. You can also plot text for each one of the signals. I've chosen just a nit by an ape based on the fact that on a fast up cross, I assume that's going to be the first signal that we get. So that would be kind of our initial buy signal. And then our medium up cross would be the fast VWMA over the slow MSMA. So I'm assuming that would be the second signal that we get. And the third signal that we might get would be the crosses of the slow VWMA and SMA. So I put ape because, that's what we do when we're very confident about a position. And then text color white and the size of the indication small. So very simple. Now we can simply save this. And let's see what we got. We're on Bitcoin on the daily time frame, and we've got a lot going on here. All right. But let's just give this the eyeball test and kind of see how we do. So let's look at a downtrend where we're going to be able to pick up the most profit. We're getting good sell signals here at the beginning of the downtrend. We're getting continuing sell signals throughout this range. About through the middle of this breakdown. And as the trend pauses here, as we get toward the end and price actually starts trending above these volume weighted moving averages, we do get a buy and an ape signal. So we get the medium and the final buy signals right here. Those are false signals. We do actually continue going down. We get some continuation right here leading to this. And then this is pretty interesting. We get this divergence signal right here. Remember that, as we can see here, the red line is the slow simple moving average, and the green line is the slow volume weighted moving average. So remember, when we're in a downtrend and we begin to see the volume weighted moving average move above the simple moving average, that indicates that we're having bullish divergence. If we're in a downtrend, if price is moving down and our volume weighted moving average is trading above our simple moving average, that is bullish divergence. And as we can see, when this when we get this signal on this candle, price basically comes down for a few candles more and then just begins moving up for quite a long time, where we get some initial buying confirmation. Now, we do have areas of the chart. This is an area right here where we have conflicting signals. We have another area of the chart where we have conflicting signals right here. And we can't help that. Again, we just want to give this an eyeball test. And this is what I do with all of the strategies that I come across, is I do this eyeball test and I see if there is some interesting merit here, if it's worth putting into a back tester. So far, I see that we've got nice confirmation on downtrends. We have some interesting divergence. So here's another example of that kind of interesting divergence. And this one was timed less well. We had a little bit more downside here and some volatility. But as we can see, these divergence signals are coming in really nicely, as are the buy signals here too. One here at the kind of the close to the bottom of this downtrend, and then this on the confirmation of the breakout. We've also got kind of a sell signal up here as we come to the top of this range. And here we've got some nice divergence here. We do have a bad buy signal here. And here we have, again, divergence. There was some divergence, but not enough for a sustained profitable movement. And then we have those nice sell signals. And then we have some nice buy signals in an uptrend. And we've got some chop here. All trend following indicators are going to do poorly in chop. So initially, I see that this indicator seems to have merit as a trend following indicator with a little bit of refinement and cutting out some of the noise. And we also seem to have a pretty interesting strategy or indication here of when we're seeing buyer exhaustion during uptrends, i.e. bearish divergence during an uptrend, and bullish divergence in a downtrend. So places where we might potentially want to look to go long. And if we remember, the original idea did promise that we would be able to spot some interesting divergences. We can see that here. So I am immediately interested in adding a layer of refinement into the code by modifying or adding signals based on where price is in relationship to the moving averages. For example, to identify the difference between kind of a bearish sell signal when price is underneath the moving averages and a divergence signal when price is above the moving averages. And I think that would help cut out a lot of this noise by printing different indications for us. But we'll get to that in a bit. From here, let's take this idea, let's take this code and simply port it over to a strategy tester to get some raw initial data on how each signal works on its own. I will be testing each signal on 3 different time frames: the daily, the 4-hour, and the 1-hour, as those are time frames that can be comfortably traded manually and automatically. So this is really easy to do. Again, I've already done this, so I'm just going to copy and paste. And the first thing that we're going to do is we're going to pull up in our code, and we are going to change this from an indicator to a strategy. So we're just going to kind of use my boilerplate strategy header right here. And boom, this thing will now be a strategy. Now we just need to add in some code, some ATR code, average true range code. I like to use that for my take profits and stop losses. And then we'll also need to write in what our stop losses and take profits are going to be, and then some strategy code to actually simulate trades. So we're going to take this ATR code right here. And all we're doing here is establishing average true range so we can call it later in the code. And then we're selecting ATR times 1 is going to be our take profit target. 1.5 times the ATR is going to be our stop loss. And then this is just code that measures whatever that distance is from our entry price. So that's all that is right there. And then we're going to add some code in here to give us a time frame of when this back test is going to take place. Start time and an end time, and the back test will only run if current time is between that start and end time. And then we just need to put this at the bottom of our code, which is going to be our entries and our exits. So strategy entry, we're going to go long when we have a signal, and we're going to go short when we have a signal. And we're going to exit our long trade if we hit our stop loss or if we hit our take profit. So pretty simple. And now all we need to do is, this is the magic right here, this when part. So strategy entry, when. So we're just going to test these signals. We only have to do this 3 times because we're going to be testing a long and short strategy together. You can, of course, based on your preference, your risk tolerance, your style of trading, decide to just test for longs, and you will get different results because you won't have the short trades in there influencing your results. Or you could test for shorts. And also, this is an area where you will have to build your experience and determine when you want to switch between a long only strategy or a short only strategy, or if you have a robust long and short strategy. Just all depends on the work that you want to put in and what fits best with your style of trading. So what we're going to do here is we are going to test the fast crosses first. So we're going to take our fast up cross and replace that as the when for our long entry. And then we're going to take our fast down cross and replace that as the when for our short entry strategy. And then that should be all we need to do. We're going to hit Control S or save on the keyboard, and we're going to get some results. Huzzah. Now, this doesn't look great. I don't want you to be worried about the actual P&L or profitability right now because we haven't actually coded in a risk management system. And this is our initial backtesting phase. So when I am doing my initial backtesting, the only thing that I'm looking at is percent profitability. That is the only thing I care about. I want to know how frequently this strategy wins as opposed to loses. And once I understand that, I'll start optimizing around that. Excuse me. In my experience, and everybody has a different opinion about this, but in my experience, it is just so much easier to actually stick with a strategy if it wins more frequently than it loses. There is a lot of material out there about trend following trading, and a lot of people have the opinion that most profitable trend following strategies will have a lower hit rate but greater profits. And you can obviously always work toward that and build that, but my personal experience has taught me that strategies that lose most of the time are very psychologically difficult to stick with. And if you're psychologically struggling with your strategy because it's losing a lot, it's harder to stick with it so that it can eventually turn a profit. So things to consider, I think, for the beginner trader and for people building their first strategies, or for people who are not yet consistently profitable, focusing on percent profitability and the hit rate is the absolute best place to start. It's how I start all my strategies. So we're going to be focusing on this percent profitability, and we're going to, as I said, be testing on the daily, the 4 hour, and the 1 hour. So we can see that this has a 52.41% profitability. Now that's not bad, but it's not good. That's just a little bit better than a coin toss. And, we want to be very resoundingly beating a coin toss. Now, in Pathways to Profit, the way that I always teach people, their minimum baseline for an initiator needs to be at least 55%. And the higher we can get that, the better. So 55% is where we can start, because ideally we want to get our hit rate up to about 65 to 70%, if not higher, by adding layers of complexity, by adding layers of confirmation, and then optimizing our profitability with our stop loss placement, our position sizing, and our take profit placement. That's how we're going to take a winning strategy that wins frequently and turn it into a profitable strategy. So there's a big difference. You can have a strategy that wins a lot, but loses money, because even though you win a lot, when you win, your profits are small, and when you lose, your losses are great. So that is a bad stop and target system, and that is a bad risk management strategy. So again, we're going to start by optimizing a high hit rate indicator or strategy, and then we're going to make it profitable by adjusting our risk management and take profit and stop loss aspects of the strategy. Okay, so 52.41%. This is on the daily time frame, 166 trades, so a good sample set. And we'll go down to the 4 hour. Again, about 0.1% higher, so 52.42%. And down on the 1 hour, 50.75%. So not great. This is the fast volume weighted moving average cross over the fast simple moving average cross. So very sensitive. And I do believe that parameter is 13. Yeah, so this is a 13 fast VWMA over a fast 13 SMA. So I'm not too excited about this strategy, but let's record our results down so that we can always reference it later, and we'll come back to this in just a little bit. So now we're going to go back to our Pine editor, and we're going to check for our medium crosses now. So we're going to take our medium up cross variable, and we're going to replace that as the when for our long strategy entry, and our medium down cross, and replace that for our when strategy short. And we're going to save. We're going to go back to the daily, and let's see how our strategy does here. Okay, 55.71%, much better. Only 70 total closed trades, not the greatest sample set, but not bad for a daily strategy on Bitcoin. This is worthy of further iteration and see if we can improve this. Let's go down to the 4 hour, 58.6%, even better. And this one was profitable, even though very volatile, for the majority of its lifespan, and then it kind of had a big losing streak and just stayed down there. But as you can see, even after that big losing streak, it came back almost all the way to profitability. This thing was down. Let's see here. This thing was down about 18% and then came all the way back up to only down 10% before kind of hanging out where it is right now. So not too terrible. And we did achieve a max profit of, let's see here, about 7%. Okay, about 7% before we had a loss. So not too terrible. And again, a good hit rate. So this is a strategy that could potentially be optimized with a better stop and target system and a better risk management system. Let's go down to the 1 hour, 57.46%, very consistent. All right. So again, we started off with initial wins, kind of drained that out, tried to come back, and then the strategy just kind of bled out. So max drawdown of 21.57%. So still better than investing in Luna, but this is, again, these are good starting numbers. This is significantly higher than being more right than a coin toss. This is almost 8 to 10% higher than being right than a coin toss. So this is good. We can optimize and iterate upon this. So let's record these results and we'll come back to this. Let's test the last one. So this is going to be the slow up cross. And the slow down cross. So we'll save, go back to the daily, go back to our strategy tester. And what's the immediate thing that we see? This is the daily time frame, and we can see that we actually have a 62.07% win rate out of the gate, and we have a profitable strategy. This thing produced, and again, this is just with, if you guys are interested, the way that I have this coded in is we started off with an initial balance of $10,000, and we're just simply putting 30% of our money into each position. That's it. So so obviously as we gain money, our position sizes will become larger. And as we lose money, our position sizes will get smaller and smaller and smaller. But this strategy right out of the gate has a 62% win rate, a 28.41% profitability. So we made almost 30% of our money with a max drawdown of only 12.83%. And this thing does have the kind of nice 2 steps forward, 1 step back, 2 steps forward. We haven't yet seen the 1 step back, but it would be interesting to see this play out over a wider sample set of trades. Only 87 trades, so I don't want us to get too excited because we do want a larger sample set. But when we're talking about the daily time frame for Bitcoin, again, how often can you trade? The more you trade, the more you'll likely use. So not bad. Let's go down to the 4-hour time frame. And we lost our profitability, but again, we're not focused on that. I didn't want to get us too excited. 56.4%. So again, not bad. Just about as good as the previous, as the medium cross strategy that we we're just testing. And then down here on the 1 hour, not so great, pretty much a straight line down, 52.22%. So potentially what we would find out by iterating upon this strategy more is that the daily is actually not significantly profitable, that this is a bit of a statistical anomaly because we don't have enough trades, and that over a wider sample of trades, this strategy indicates that it's actually not profitable. The 4 hour, again, does seem promising, and the 1 hour doesn't seem supremely promising, but you would be surprised at what we could accomplish with a little bit of iteration. So overall, after all that testing, our best result was that last one we just looked at on the daily, but our most consistent result was the fast volume weighted moving average crossing over the slow simple moving average. That's that medium cross strategy that we were testing. And we had, with that strategy, we had 55% on the daily, 58% on the 4 hour, and 57% on the 1 hour. So those are pretty good results. That would be the strategy that I would most be interested in to iterate upon by trying to filter out some of the noise. First, comparing how the long trades compared to the short trades, seeing what confirmation I could add to the strategy to make it more successful by adding a confirmer for the long trades and the short trades. Again, the first thing that comes to my mind is by programming our signals relative to where price is, relative to the moving averages. So long signals if price is above the moving averages, and short signals if below, for example. Or we can always use another type of indicator, something from the premium indicator suite like Parallax or Minx, or perhaps something like the True Strength Index, or Squeeze Momentum Indicator, which is very popular for automated strategy creation. But that's where I would start. Now that I've tested this and I know where to focus my efforts, I know that I'm initially excited about testing for those moving average cross entries on that medium time frame, with the fast volume weighted moving average crossing over the slow simple moving average. And then the interesting thing is, if once I have success there, then I could go back and revisit those other maybe underperforming strategies, and we might actually see that they actually perform better once we layer on those levels of confirmation. That's all I have for this presentation in this video. In the next one, I'm going to take us further and add those layers of confirmation on. And in addition to that, I think I'm also going to play around with what I initially saw as interesting in the first place, which was this idea of divergence. And to show this, I want to go to the daily, and we're just going to eyeball this a little bit. So what I want to do is, what I'm interested in looking at is, I'm just going to take I'm going to take the fasts off, and I'm just going to be looking at the slows. So these are the 26 period SMA and the 26 period volume weighted moving average. And I'm interested in this as a potential exit indicator or as a potential reversal entry indicator. And we're going to be looking for those divergences. So notice that when we get toward the top of this uptrend here, price has been moving up and up and up and up and up. And notice that when we actually reach the top, before price actually chunks down, we actually get the slow volume weighted moving average, in this case, just the volume weighted moving average, to cross under this simple moving average. And that actually happened the candle after the high. And actually, it was the second highest candle in that series. So right here, we kind of got that initial divergence signal, which should alert us to potentially begin scaling out of our longs, or potentially even looking for a short, which would have been very profitable. And if we just look at current events, we see that price had been meandering along. And let's go and see when we actually had that crossover. Well, we have one here. So here, price has been downtrending. And actually, we have it here too. So on this candle right here, and we do have more downside, but we get our first crossover. So this is kind of alerting us that, hey, we should be looking to scale out of our short, or potentially even look to pick up longs upon further confirmation. And overall, this area right here was not a bad area to enter into a long. You had to sit through this, but you had profit opportunity. And then you kind of got a reversal of that signal. The volume weighted moving average moved back down below. And then over here, the volume weighted moving average moves above the simple moving average on the bar prior to a 2-bar up movement. Now, not huge, not sustained. And on the very next up candle, we have that bearish divergence again, telling us, hey, party's over, time to get out of the long, and price moves down. And here we have that confirmation again. The volume weighted moving average moves above the simple moving average. And although we have a pullback, we have nice blue skies ahead. And then we have this was a very fast movement. This was the FTX collapse. So again, no level of technical analysis can typically capture these movements. But what's interesting to me is that as we see price move sideways here, again, our volume weighted moving average here begins moving above our simple moving average. And what do we have several candles later? We have a pretty nice big up move coming up towards our volume weighted moving averages. So I think this has a lot of merit. Here's another really cool example. We have a pretty nasty downtrend here. And then here on this candle, which is actually the last significant red candle in the series, we get that same crossover and a pretty significant up movement. So for discretionary trading, that seems to be the signal that I'm most interested in, is the ability for this thing to detect very reliable divergence that doesn't rely on a momentum oscillator. It relies on the relationship between volume moving averages and non-volume moving averages. So there's a lot of merit in that for me. And that's what I would personally be interested in identifying, maybe using discretionarily or seeing if we can't program that up. So we'll play around with those ideas next time. And we'll also see if we can't add layers of refinement to our original simple moving average cross strategy to see how we might not be able to make it better. Hey guys, thanks so much for watching all the way to the end. If you enjoyed this content, make sure to push the thumbs up button. Lets me know you liked it and also incentivizes me to make more great content. And at the same time, if you're down there, make sure to subscribe to the channel so you never miss another trading video. If you want more content, check out these suggested videos to your side, and we'll see you on the next one.